Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, December 12th. Major US indices traded with joy yesterday after the US CPI update revealed no major surprises, cementing the expectation that the Federal Reserve will cut by another 25 basis points when it meets next week. Then the Bank of Canada cut by 50 basis points yesterday, and the European Central Bank and the Swiss National Bank decide today, and both are expected to announce further easing as well. So, Merry Christmas in advance. So yesterday's inflation data from the US was seen as the last possible barrier to the much expected extra 25 base point cut from the Fed next week, and the release went quite well. The figures came spot on what was expected by analysts. In numbers, headline inflation inched slightly higher from 2.6 to 2.7%, while core inflation remained sticky around the 3.3% level. Now, if you ask me, with Donald Trump's pro-growth policies and tariff threats threatening to give a positive jolt to inflation figures in the US in the coming months, a core inflation figure that's insistently above the 3% mark doesn't necessarily call for an additional 25 base point cut from the Fed, but this is most probably what the Fed is going to do still. They will probably cut one more time this year, with activity on Fed funds futures assessing nearly 100% chance to this scenario. Then we will probably see the Fed take a breather in January. As such, the US 2-year yield is now around 4.16% level, having held ground above the 4.10% mark earlier this month, certainly on thinking that the Fed should eventually slow down its rate cuts next year. Then the US 10-year yield is advancing toward the 4.30% level again, up from 4.13% at the lowest of December, and the major US indices will rally with joy. Obviously, the S&P 500 closed a few points below an all-time high level yesterday, while Nasdaq 100 jumped 1.82% to an all-time high level. But it's not only the Fed, happily, it's also the technology-related news, because Google, for example, jumped nearly 5.5% yesterday to a record high on news that the company made a major development in quantum computing using its Willow quantum chip that helped the company's quantum computer to solve a problem in just 5 minutes instead of 10 septillion years if you use a supercomputer. Now, obviously, the company didn't give away any real-world use cases for such a powerful computing, and quantum computers are far, far from mass adoption just yet. But the latest news from Google gave hope to Google's investors that the company is here to stay as a technology leader, and that its Willow chip could eventually give them an advantage in their AI race. Now, before I move forward with the chips, quantum stocks gained yesterday on Google's news. Defiance Quantum ETF, for example, jumped to an all-time high level before giving back pretty much all of the gains. Now, the price moves in quantum space will likely be volatile at this stage of the game, given that commercialization is not due in the foreseeable future, but chasing interesting entry levels is interesting. Now, coming back to my chip story, Broadcom, that's due to announce its quarterly earnings today, flirted with an all-time high level as well yesterday, and that was on news that they are now developing an AI chip with Apple, who is also interested in Amazon's Trainium chips, mind you. Now, of course, the news that the big technology companies like Google and Apple are now building their own chips to train their own AI models could eventually be bad news for Nvidia, which actually made around 50% of its last quarter revenue from these big technology companies. But happily for Nvidia, well, TSMC, who builds their chips for them, said that its sales rose 34% in November, hinting that AI demand remains strong despite the growing worries of slower spending from the big technology company. So Nvidia gained more than 3% at yesterday's trading session, while AMD rebounded 1.90% from the lowest level since the summer. Now, here in Europe, The market news are much less futuristic, they're much less future oriented and exciting, to be honest. But the SOX 600 index was better a bit yesterday on hope that the European Central Bank will step up its support to the European economies. In this context, the ECB is expected to deliver another 25 basis point cut at today's monetary policy meeting. Some have been expecting the European Central Bank to do more than that. Remember, because since Donald Trump won the US presidential election, the increased risk on European economies, essentially due to the tariff threats from Donald Trump, brought some investors and analysts to bet for a 50 basis point cut today as an immediate reaction. Others, like myself, think that the European Central Bank would better deliver a cautious 25 basis point cut today and shift its focus from inflation, that is probably on path toward the 2% target, to growth, that is on slippery ground due to weak economic activity in the European countries, political turmoil, so the last two often go hand in hand, and the increased international trade threats. Because doing so, shifting focus from inflation to growth, will open the way for a series of rate cuts for the ECB instead of a jumbo rate cut that the zone doesn't need in a hurry. And I want to believe that the European policymakers are, well, somehow less impulsive than their American peers, and they will not rush to the exit without considering risk on price stability. Voila, that's my opinion. Let's see what the European Central Bank decides today. Now, as I said earlier this week, I do not expect the euro to be aggressively sold in both cases, provided that the dovishness from the European Central Bank has been already widely priced in, and that's starting from Donald Trump's victory day. The euro dollar, for example, fell from around 110 to 103.40 level over that period. As such, I wouldn't be surprised to see the euro bulls to resist to a dovish announcement from the European Central Bank today if Lagarde could convince investors that they are taking these measures to boost growth in the Eurozone economies and that the measures could work. Of course, there is no telling that a growth supportive monetary policy from the European Central Bank will lead to growth in Europe, especially given that the member states are now expected to, or they should, tighten their fiscal policies to control their budget deficit levels, and that is not necessarily growth supportive, mind you. And yes, I'm looking at you, France and Germany, but in all cases, a sufficiently supportive European Central Bank stance and a contained euro depreciation could back a further rise in European stock valuations and eventually help them to extend their rally. Now, obviously, we all know that the valuations on the index level hide the ugly economic fundamentals of the Eurozone and the Eurozone companies, as only a handful of these European companies have contributed to the gains that we see at the index level. Those companies include SAP, for example, that benefits from the AI rally, Siemens and Novo Nordisk for their obesity drugs. But the car makers and the European luxury stuff makers, for example, struggle big time. So stock picking in the European equity complex is still a good idea, in my opinion. Other than the European Central Bank, the Bank of Canada cut its rates by 50 basis points yesterday, and the Swiss National Bank is also deciding today and could cut its rates by 25 or 50 basis points to help SNB counter the franc's appreciation. But that decision will be made by the time this video is published, so I will react to this decision in tomorrow's episode. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.